You're watching the latest news from FinancialMirror.tv. Governments across the world moved to shore up tottering global banks with multi-billion-dollar bailouts on Monday as Britain called for a new agreement to reshape the world financial system. Prime Minister Gordon Brown called for the creation of a new financial architecture to reflect the global reach of economics and banking, in much the same way that the current international economic system was set up at a conference in Bretton Woods, New Hampshire, in 1944. Britain said it'll spend up to $37 billion buying into top UK banks such as Royal Bank of Scotland and lender HBOS. France will offer €300 billion in guarantees on interbank lending and a €40 billion fund to take stakes in companies. Germany will provide up to €400 billion in guarantees for banks, and Japan said it'll consider guaranteeing all bank deposits. Eurozone leaders held an emergency meeting on Sunday, and French President Nicolas Sarkozy said people could expect a flurry of coordinated announcements. In tandem, European central banks said they would lend out as much US dollar liquidity as commercial banks need in a bid to tame money market tensions. In a joint announcement, the US Federal Reserve, the ECB, the Bank of England and the Swiss National Bank said they would meet all bids from commercial banks at a fixed interest rate. Australia and New Zealand earlier guaranteed all bank deposits, and India pledged more liquidity to help financial markets. Money markets, the heart of the credit crisis, eased but remained tight. 3-month EURIBOR interbank lending rates fell but remained above expected Eurozone interest rates, implying that banks continue to demand high premiums to lend to each other. Banks deposited a record €155 billion overnight at the ECB rather than lend to each other. Britain's top share index gained more than 4% by noon on Monday, recouping some of last week's heavy losses as a government deal to pump billions of pounds into the troubled banking sector lifted market sentiment. Oil and mining stocks rebounded strongly as commodity prices recovered and some banking stocks gained, but HBOS, Lloyds TSB and Royal Bank of Scotland tumbled again as investors feared the government taking stakes in these firms. The FTSE 100 had gained ground on Monday after falling 9% on Friday and a total 21% last week, its biggest fall since 1987. HBOS and Lloyds TSB shares lost ground as they tried to renegotiate the agreed takeover, and Royal Bank of Scotland tumbled more than 20%. Barclays gained nearly 7% after it said it would boost its capital by more than £6.5 billion, but without government help. Standard Chartered gained more than 10% after it said it was well capitalised and highly liquid. Insurers Prudential and Standard Life were up about 6% each, while interdealer broker ICAP was up 11%. Energy stocks gained as oil climbed more than $3 a barrel, recouping some of Friday's 10% dive, as nervousness on the future of the world economy eased somewhat. Oil rose above $81 a barrel on Monday after the governments around the world acted to boost confidence in the global banking system, spurring a rally in European and Asian stock markets and commodities. But investment bank Goldman Sachs said the financial crisis had already done more damage than it expected to commodity demand and warned that a slide to $50 a barrel for oil could be possible. Goldman Sachs, a long-standing commodity bull, turned a near-term bear on Monday after conceding that global financial turmoil would take a far bigger toll on demand. The bank cut its year-end US crude oil target to $70 a barrel, down from a previous forecast of $115, and slashed its average 2009 forecast by a third to $86 a barrel. A fall in demand in America and other developed economies has helped drive oil down nearly 50% from its July peak above $147 a barrel. A boom in consumption from emerging markets such as China has also contributed to a 6-year rally in commodity prices. Economist Paul Krugman, a critic of the Bush administration for policies that he argues led to the current financial crisis, won the 2008 Nobel Prize for Economics. The committee awarded Krugman the prize of $1.4 million for work that helps explain why some countries dominate international trade. A prominent economist who writes columns for the New York Times, Krugman has long featured among the favourites to win a Nobel. A professor of economics and international affairs at Princeton University, Krugman has been heavily critical of President Bush's administration. The Royal Swedish Academy of Sciences said that Krugman's approach is based on the premise that many goods and services can be produced more cheaply in a long series, a concept generally known as economies of scale. The Academy added that consumers demand a varied supply of goods. As a result, small-scale production for a local market is replaced by large-scale production for the world market, where firms with similar products compete with one another. Krugman's theory clarifies why trade is dominated by countries that not only have similar conditions, but also trade in similar products. The committee cited Sweden as an example, as it both exports and imports cars, showing a kind of trade that enables specialisation and large-scale production, which result in lower prices and a greater diversity of commodities. And if you thought you lost money on international stocks, you're lucky you're not Nicholas Hayek, chairman of Swiss watchmaker Swatch. Hayek said he's lost about 3 to 4 billion Swiss francs on paper as a result of the financial crisis and is furious but not worried. Hayek said that sales of the group's mid-range watches, including Breguet, Omega and Blancpain, were much higher at the end of September than for the same 9-month period a year ago. The outspoken Hayek is generally credited with rescuing the Swiss watch industry from collapse in the 1980s after low-cost Japanese quartz timepieces obliterated sales. He's among 7,642 multimillionaires living in Switzerland. Ingvar Kamprad, founder of the IKEA chain, is Switzerland's wealthiest resident. Thank you for watching FinancialMirror.tv.